Stop looking at the green arrows on your screen. They are deceiving you. Stop listening to the financial news anchors telling you that we are in a new golden age. They are paid to keep you invested. While retail investors are celebrating record highs in the S&P 500, a much darker, more significant story is unfolding in the background. It is a story of distribution. It is a story of exit liquidity. And most importantly, it is a story of betrayal. As we close the books on 2025, we are witnessing the single largest divergence between stock prices and economic reality since the peak of the dot-com bubble. The narrative that artificial intelligence will exponentially grow corporate profits forever has seduced millions of people into paying any price for a piece of the action. But while you are buying the dream, the very architects of that dream, the CEOs, the founders, and the insiders, are selling. They are selling at a pace we have not seen in decades. What do they know that you don't? Why are they building bunkers of cash while telling you to buy the dip? Today, we are going to dismantle the 2025 bull market piece by piece. We are going to perform a forensic audit of the Magnificent Seven. We are going to expose the mathematical impossibility facing NVIDIA, the valuation nightmare of Tesla, and the diminishing returns of the AI capex bubble. But we will not leave you in the dark. We are going to construct a fortress-like investment strategy for 2026, identifying the specific sectors that will rise from the ashes when the tech bubble finally bursts. This is the blueprint for the Great Rotation. To understand where we are going, we must first understand the structural fragility of where we are. The 2025 market is not a broad, healthy bull market. It is a K-shaped illusion. If you strip away the top 7 or 8 technology companies, the S&P 493 is effectively flat or down in real terms. We have a market that is being held up by a handful of pillars. If just one of those pillars cracks, the entire roof comes down. And right now, those pillars are trembling. Let's start our deep dive with the king of the market, NVIDIA. For the last 2 years, NVIDIA has been the only stock that mattered. It is a fantastic company with a revolutionary product. However, as value investors, we know that a great company can be a terrible investment if you pay the wrong price. NVIDIA is currently priced as if it will maintain a near monopoly on AI chips for the next 10 years, with profit margins that rival software companies. This assumption violates the basic laws of capitalism. Here is the reality that Wall Street is ignoring: the capex wall. NVIDIA's biggest customers, Microsoft, Meta, Google, and Amazon, are spending hundreds of billions of dollars buying NVIDIA chips. But they are not doing this because they are making massive profits from AI yet. They are doing it out of fear. They are in a prisoner's dilemma, terrified that if they don't spend the money, their competitors will crush them. But this spending cannot last forever. We are already seeing reports that the return on investment, the ROI, for generative AI is lower than expected. If Microsoft or Meta decides to cut their AI spending by just 10% in 2026, NVIDIA's earnings growth will collapse. The stock is priced for perfection, but the demand drivers are fragile. Furthermore, competition is arriving. AMD, Intel, and most importantly, the custom chips being designed by NVIDIA's own customers are coming online. When supply catches up with demand, margins contract. And when margins contract on a stock trading at 40 times sales, the crash is violent. Now, let's look at Tesla. The narrative for Tesla has shifted from "it's a car company" to "it's an AI and robotics company." This narrative shift was necessary to justify the valuation because the car business is brutal. In 2025, we saw EV demand plateau and competition from Chinese manufacturers flood the global market. Tesla's automotive margins have compressed significantly, yet the stock is trading as if the Optimus robot and the robotaxi fleet are already generating billions in pure profit. This is dangerous. We are pricing in execution that hasn't happened yet. The market is ignoring the regulatory hurdles of autonomous driving. It is ignoring the immense capital costs of building humanoid robots. Investors are buying a lottery ticket on 2030, but they are paying a premium price in 2025. If the US economy enters a recession in 2026, consumers will not buy $50,000 cars, regardless of whether they drive themselves or not. Tesla is a cyclical industrial company priced like a high-growth software monopoly. That disconnect is a recipe for disaster. We must also talk about the boring giants, Apple and Microsoft. Apple is widely considered a safe haven. But look closer. Revenue growth has been stagnant. The innovation cycle has slowed. The company is effectively engineering its earnings per share growth through massive stock buybacks. While this supports the stock price, it is not organic growth. It is financial engineering. When a company runs out of ideas, it buys back its own stock. Microsoft, on the other hand, is betting the farm on OpenAI. While they have the best position in software, they are also spending the most money. The depreciation costs of all those data centers they are building will hit their income statement in 2026. If AI adoption by enterprises slows down, Microsoft will be left with massive fixed costs and shrinking margins. The market has priced these companies as safe, but at these valuations, there is no safety. So, if the fundamentals are cracking, why are stocks still going up? The answer lies in passive flows and liquidity. Passive investing index funds and ETFs now accounts for the majority of market volume. When you buy the S&P 500, you are mindlessly buying the biggest companies regardless of their price. This creates a self-fulfilling prophecy. The bigger they get, the more money flows into them, and the bigger they get. But this works in reverse too. When the selling starts, the passive funds sell indiscriminately. The liquidity that drove stocks up will evaporate on the way down. Additionally, we have been living in a period where government deficit spending has injected trillions into the economy. But in 2026, the bond vigilantes may finally wake up. The US debt interest payments are now exceeding the defense budget. The bond market is signaling that this level of spending is unsustainable. If long-term interest rates rise further, the valuation models for all tech stocks break. This brings us to the most critical signal of all, the behavior of the smart money. In Q4 2025, we tracked insider transactions across the tech sector. The ratio of selling to buying is at historic extremes. The people who run these companies are cashing out, but the most telling move comes from Warren Buffett. Berkshire Hathaway is sitting on the largest pile of cash in its history. Buffett has been systematically selling down his largest positions, including Apple. Why? Buffett plays the game of probabilities. He knows that the Buffett indicator, the ratio of total market cap to GDP, is flashing red at over 200%. He knows that you cannot get good long-term returns buying stocks at these levels. He is not timing the market. He is pricing the market, and the price is wrong. He is preparing for a liquidity event. He is keeping his powder dry to buy high-quality assets when there is blood in the streets. So, what is the playbook for 2026? How do you protect yourself and profit from the inevitable mean reversion? The strategy for 2026 is the Great Rotation. We believe capital will flee the overcrowded, overvalued digital economy and flood into the undervalued physical economy. Sector 1, the energy supercycle. The AI revolution has a dirty secret. It is incredibly energy intensive. A simple ChatGPT query uses 10 times more energy than a Google search. As AI models get larger, their energy hunger grows exponentially. The US power grid is old and maxed out. We are facing a structural energy shortage. While everyone is fighting over who makes the chips, the real bottleneck is who powers the chips. We are incredibly bullish on natural gas and nuclear energy. Natural gas is the only bridge fuel capable of meeting the immediate demand of data centers. Pipeline companies and producers are trading at single-digit PE ratios while sitting on the most valuable commodity of the AI age. Nuclear energy is the long-term solution. Uranium miners and nuclear utility companies are poised for a multi-year bull market. You cannot have a high-tech future with low-tech energy. The disconnect between tech valuations 30x earnings and energy valuations 10x earnings is the single biggest arbitrage opportunity in the market right now. Sector 2, healthcare and demographics. If the economy slows down in 2026, which the yield curve predicts it will, you want to own inelastic demand. People can stop buying the new iPhone. They can stop subscribing to Netflix. They cannot stop taking their heart medication. They cannot stop treating cancer. The healthcare sector has been left behind by the AI rally. As a result, many top-tier pharmaceutical companies are trading at bargain valuations, paying dividends of 3 to 4%. But there is a catalyst here too, the patent cliff. Many large pharma companies are losing patent protection on their blockbuster drugs. They have piles of cash and need to buy innovation. We expect 2026 to be a record year for biotech M&A. Small and mid-cap biotech companies with promising clinical data will be acquired at massive premiums. By owning this sector, you get defensive safety plus the lottery ticket of acquisitions. Sector 3. Small cap value. The Russell 2000 has underperformed the S&P 500 for a decade. The valuation gap between the biggest stocks and the smallest stocks is at levels seen in 1999. Small caps have been crushed by high interest rates because they rely on floating rate debt. However, as we move into 2026, if the Federal Reserve is forced to cut rates to support the economy, small caps will benefit the most. Their interest expenses will fall, and their profits will explode. This is a mean reversion trade. If the valuation gap closes just halfway, small caps could soar while the S&P 500 stays flat. Sector 4. Hard assets, gold and commodities. We are entering an era of fiscal dominance. The US government cannot afford to let the debt implode, so they will eventually print more money. This is the debasement of currency. Gold is the ultimate hedge against central bank incompetence. It is not just a rock. It is a currency that cannot be printed. As geopolitical tensions rise and trust in the US dollar fluctuates, central banks around the world are buying gold. You should too. It is the insurance policy for your portfolio. Strategic conclusion. The mindset for 2026. The year 2026 will require a completely different mindset than 2025. The easy money is gone. The buy and hold strategy for tech stocks is now a high-risk gamble. You need to become a contrarian. When your Uber driver gives you stock tips about AI, that is a sell signal. When the news headlines scream about a new all-time high, that is a signal to take profits. The wealth transfer of 2026 will be from the impatient to the patient. It will be from those who chase hype to those who study fundamentals. Don't be the person holding the bag when the music stops. Be the person who prepared the exit. Sell the euphoria. Buy the panic. Focus on cash flow, not stories. Focus on dividends, not dreams. The market is a mechanism for discovering truth, and the truth is coming. Are you ready? Thank you for watching. If you found value in this deep dive, please subscribe to the channel, as we will be tracking these data points in real time throughout the coming year. The era of easy money is over. Now, the real work begins.